members and other key players in the investment industry can interact and grow. When you have the CFA charter, you're globally recognized. Take advantage today by writing the CFA exam and joining us at CFA Society Nigeria. For more information, visit us at cfasocietyn.org. CFA Society Nigeria, making finance a force for good.
Good morning, everyone.
Good morning.
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 If you're not speaking, can you please mute your microphones? Thank you. Good morning,
good
everyone,
morning.
once again.
Good morning.
My name is Kikeme Shubi, and it is my pleasure to welcome you all to our webinar this morning. The Gender Diversity Committee of CFA Society Nigeria has carefully chosen a webinar on risk management titled The Art of Hedging in Personal Finance, an aspect of finance rarely spoken about, and when discussed, often associated with large institutions who engage in derivatives, FX trading, etc. Forgetting that every investment comes with its own risk, including sovereign debt, that we often believe is a low risk or zero investment. With the current economic climates, high inflation, low interest rates, currency devaluation, high energy costs, etc., many of us have looked and are looking to augment our salaries, protect our investment from high inflation, currency devaluation, amongst others. That has meant taking an increased level of risk, no matter how small. A lot of us have shifted our investment from treasury bills to bonds, to equities, to dollar investment, commodities, and to some other types of product that I can't mention on this call, all in search of higher risk. But how many of us have considered the risk associated with those investments? The session this morning is aimed at helping us understand the risk of our investment options, or more importantly, learn how to hedge or protect ourselves from those risks. This is a professional learning event that qualifies attendees 1.5 PLC credits. I encourage all society members who participate in this live session or watch the replay to record their PL credits. To facilitate the session this morning, we have the pleasure of Funmi Adepoju as our guest speaker. I'm actually intimidated by her bio. Funmi Adepoju is the managing partner of Pearl Mutual Consulting Limited, a firm that offers financial advisory, capital raising, risk management consulting, and professional training services in Nigeria. She is a fellow of the Institute of Chartered Accountants of Nigeria. Her work experience spans various areas of the financial sector, including banking, development finance, private wealth management, economic research, business incubation, risk management, and ratings. She has had the opportunity to partner with multilateral bodies like the USAID and the Alliance for Green Revolution for Africa on projects that promote sustainable growth in the agricultural sector. Through her participation in the West African Trade and Investment Hub project of the USAID that ended in 2017, she developed a deep passion for helping SMEs obtain better access to funding and improve their professionalism. In the last 4 years, she has worked tirelessly with the Pearl Mutual team to raise funds from high net worth individuals in form of equity and debt. The project has created more than 800 jobs within that period. Funmi is passionate about impacting knowledge and delivers talks and trainings regularly. She is a CFA charter holder and a certified FRM financial risk manager. The session this morning will be moderated by Modupeoluwa Olaniyi. Modupe is currently the head foreign exchange trading at Stanbic IBTC Bank. She is an experienced treasury professional with experience across various areas such as derivatives, interest rate and foreign exchange sales, and more recently, foreign exchange trading. She is a CFA charter holder and a member of the Chartered Institute of Stockbrokers. On behalf of the Board of Governors of the CFA Society Nigeria, I want to thank our volunteers in the Gender Diversity Committee for the amazing work they have done in putting together this event. Please enjoy the session and engage with the speakers and other attendees in the chat box. I will now hand over to the moderator. Thank you.
Good morning, everyone. Just Kike has done a lot of the introduction already. We're currently in interesting times right now where we're seeing inflation at record high levels, and a lot of countries have started to hike the interest rates just to curb this effect. And so there are possibilities of people thinking that a recession might happen. And so this theme right now is very instructive. And just to bring it home, just like Kike said, in the quest for higher yields, we have actually seen a number of people lose some money, particularly last year with some investments that are not really to be mentioned on this platform. So I'll just encourage everyone, please, let's keep the chat box popping, let's keep it buzzing, ask all your questions. We'll take it right after, and please take notes. I'm sure there's going to be a lot to be said. So right now, Funmi will go ahead and then we'll take questions right after this. Thank you.
Thank you so much, Modupe. I believe I should be able to share my screen. So I'll share my screen now. Okay, good morning, everybody. It's a pleasure to be here. And first of all, I want to thank everyone in the CFA Society Nigeria for this invite. It's humbling for me to be here. And I do hope that we'll all have a nice time as we discuss. We've already heard about the topic. It's risk management, the art of hedging in personal finance. So we're just going to be talking about a few things this morning, and hopefully we'll have enough time to take as many questions as we're going to be able to take this morning. So I'm going to be talking about, talking around 4 different areas: what is happening in the international market, what is personal finance, what are some of the steps that we can take, and then making sure that we can hedge those risks that we may actually be exposed to right now. So starting from what is personal finance? Personal finance is that process of planning and managing your personal financial activities. In other words, is understanding where you are, being able to evaluate your position, set your goals, understand the goals that you want to achieve, and then begin to execute a plan that will work for you. And the first thing I would like to mention is it's good to understand yourself, because we are all in different, unique positions. So what works for somebody, the fact that somebody did something and it worked for them, doesn't necessarily mean that it's going to work for you. So you need to be able to understand your position and monitor your position on an ongoing basis, so that when there are changes, you can take a different opinion, action as necessary. What are some of the areas where we tend to have to do something? Estate planning. The way most human beings are, as you grow up, you get to the age where you begin to work, then you want to have a family, and you want to make sure that your children have a better life than you did or you are currently having. So definitely we all are involved with estate planning one way or the other. We have to budget, we have to buy a house or build a house. If you're living in Nigeria, sometimes you can't even get a mortgage and you have to build by yourself. You need to begin to plan what you're going to do at the end of your career in terms of retirement and things like that. So these are different things that we do. This definitely will then affect different areas of our lives and our finances. Therefore, we have different things that we actually need to be doing. What are the different classes of assets that we have out there? These are not exhaustive, but they can cover most of the things that we can find. Of course, there's cash, which is usually the starting point. Then you have shares, we have bonds, we have real estate, we have commodities, gold, we have business assets, because I do not doubt that there are people here today like me that are business owners. And as a business owner, oftentimes you find out that a greater percentage of the assets that you have is actually represented in that business that you have set up. Then we have all the other non-conventional alternative investment, like everybody has been saying. Well, I may mention some of them. We have the cryptocurrencies of this world. We have, depending on the kind of access you have to different markets, whether local markets and international markets, we have your cryptocurrencies, you have your mutual funds, you have your exchange traded funds, you have quite a number of things. You have some of those non-conventional investments, like where you invest in crowdfunding and a whole lot of other factors like that. All of those things are things that we can put under alternative investment. And like we've said, a lot of us have moved in recent times towards some of these alternative investments. Why? Because they tend to have higher return, even though they come with a significantly higher level of risk. So that's why it's important for us to have some of the discussions that we are having today. Now, when we begin to plan as to how you want to manage your portfolio or your personal finances, what are some of the thoughts that we normally have in mind, or that is good for us to have if, for instance, you are new to investment and you want to know what you should do? A lot of us are looking for multiple sources of income, like those who have spoken today already have said. We're looking for making sure that if anything happens, we have that emergency cash flow that we can actually tap on. So one of the things that we must learn to do, which is one of the things that I would really repeat a lot of times in different ways today, is making sure that we are able to diversify our portfolio. Now, one of the area most people tend to fail or ignore is understanding the risk and reward segment. What do I mean by that? Sometimes you're seeing the good things, you're seeing the good side of those investments, but you're not thinking about what will happen if the market falls or if the market moves against me. In 2021, we saw a situation where Bitcoin moved from around $40,000 to about close to 60,000, and at a point it was over 60,000. And people were excited and people were just going into that investment. As we speak now, Bitcoin has gone as low as 18,000. It's up again slightly to about 21,000, and the question then is, what do you do? How do you take advantage of some of these things, but at the end of the day, ensure that you do not wreck yourself in the process of doing that? And those are some of the things that we want to be talking about today. And one of the first things I will say out at the beginning is to say it is very dangerous investing in asset classes that you do not understand, which means that before you begin to spend so much of your or invest so much of your funds into some of these investments, you need to ensure that you actually understand those investments very well. If you don't understand those asset classes, like I mentioned the asset classes earlier, if you don't understand those asset classes, the first thing you need to do is to begin to educate yourself so that you don't get the brunt of the whole situation, because there is a time to go into every market. There is a time to come out of every market. If you do not know how to read the signs very well, you may be going into those investments at the wrong time. Let me say one of the ones that people did a few years ago that maybe we haven't mentioned on this platform. A lot of people invested at one point in MMM. Not a good investment, and not something that I would advise anyone to do. But some people, we can't deny the fact that some people went into those investments and they made money. So why did it work for some and it didn't work for another set of people? It was about timing. Those who went in first were able to make most of the money. Those who went in last were the ones bailing out those who had gone in first. So how do you make sure that people do not use you to cash out? It's important for us to understand the investments that we are actually making at every point in time. What can go wrong? So many things can go wrong. And we've seen that, and we're going to talk about that in just a minute, how things can actually go wrong. So what is important for you as an individual is to make sure that for your own personal finance, you try your best to minimize your losses and cushion the effect of what we refer to as external blows. Some of the things that have happened this year, nobody was expecting them to happen at the point in time that they happened, but they've gone ahead to actually affect a lot of our portfolios in ways that we didn't even imagine. So at this point, we're going to be taking our first poll of the day. So if I can, if the CFA team can help me, please, can we put up the first poll? What are the things that have affected your finances recently? The poll, are we ready with it? Or do I need to unshare my screen? Hello, team.
Hi, Funmi, please give us a minute.
Okay, that's fine. All right, so while we're waiting for them to show up the polls, I'll just keep on talking about some of the factors that I have already mentioned. So when we talk about the things or some of the practical steps that we need to take, one of the things I said is making sure that we manage or invest our savings. The fact that you're saving, some people say to me, Funmi, I'm saving my money. You're saving your money in a current account or in a savings account that is paying less than 1%, when inflation is already at about 5%, and I'm sorry, about 17%, over 17% in Nigeria. That's not going to actually help you. So it's important that we invest our savings. Yes, I'm seeing the poll coming in. Thank you. Keep them coming. What are some of the things that have affected your finances recently? Thank you. Thank you. Thank you. All right. Okay, I believe this is going on for like 1 minute, so we'll just wait for everybody to get it in there. Thank you very much. I think I'm not surprised by the response that we're seeing here. We're seeing that the highest level of responses is coming towards what? Inflation. Out of the over 200 people, more than 76 of us agree that inflation is one of the major issues. And I believe we can all, identify with that. For those of us that go to the market to buy things that we used to buy for maybe 2,000 naira are practically going for 6,000 naira, 7,000 naira now. Gas that we used to buy for 3,000 naira is going for, as of today, is going for about 12,000 naira now. So because of that, we can all identify with inflation. Exchange rates, I don't think we need to also deny that fact. We can see over 55% of us are affected by exchange rate. And of course, it depends on what you're trying to do at that particular point in time. That's what's going to determine how some of these factors will affect you. The pandemic is, some people said the pandemic have affected them, but you can see that it's even, maybe the pandemic, directly or indirectly caused some of the things that we're seeing here, the issue of inflation, unplanned expenses, things like that. Thank you very much. I think we can end the poll at this point in time. This gives you, thank you very much for that. And you can see what we have on the board. About 219 people voted, and inflation is the key thing that we have there. It's the key thing, it's the first thing, followed by exchange rates. And that's exactly the kind of response that I actually expected to see. Thank you very much, everyone. And there are so many factors that we can actually see. In addition to those four, the poll would only allow us to put 4, but there are so many other factors that may have affected some other people as well. So I'm stopping the sharing, please. Can we stop it's still coming up? so that I can continue with the slide. So, but we can see that there are various things that have affected us. Sometimes even some of the decisions that have been taken by our government have gone a long way to affect us. So how do we then go about identifying the risk that we have in our portfolio? Please, admin, could you help me stop sharing the poll? It keeps popping up even after I have stopped it. Okay, let's go on. So how do we identify the risk in our portfolio? There are different types of risks that we are exposed to as individuals, especially as it relates to our portfolio or our personal finance. And I will discuss them very briefly. We have concentration risk. Concentration risk is the risk of loss that can happen to you because your money is invested in only one investment or one type of investment. So I'm going to give case studies to make this very practical. There was someone who was in paid employment, working in a very good organization that even allowed him to get like retirement benefits. And in addition to the retirement benefit, there was also gratuity. So because this happened to this individual in 2007, the capital market was doing so well in Nigeria at that particular point in time, he decided to retire and get his gratuity, which was at that time about 50 million naira from the organization. He got the 50 million naira and invested everything in the capital market. Fast forward to 2008, the capital market went down in Nigeria, and all of that investment of 50 million went down the drain. He had no choice but to relocate, and then he went to start work again in another climb. So this tells you what can happen. Now, what did he do that was wrong? He invested the whole of his egg, or nest, which was the 50 million, in one type of investment. Even though he didn't put it into one particular stock, he put it into different stocks, but they were in the same market. Therefore, when something happened to that particular market, he lost all of his money. So that is concentration risk. What concentration risk would have can do? What would have prevented such a thing from happening if he had invested that money in different markets rather than just putting everything into the stock market, putting it into different types of assets like what we mentioned earlier, might have reduced that. Then we have inflation risk. We've talked about inflation today, and we all have an idea of what we're talking about. We can also refer to it as purchasing power risk. This is a risk that is really beyond our control. We refer to it as an exogenous factor. It's something that is happening in the economy that is actually affecting your own portfolio. It affects every form of investment, but it can affect some investments more than others. Then we have currency risk and foreign exchange risk. This is the value of an investment, or how the value of an investment is affected by fluctuation in foreign or global currency exchange rates. And of course, this is something that most of us in Nigeria right now, we can identify with. Even if you have very good investments, if they have all been invested in Nigeria, then you may not necessarily be covered from this particular risk. I'm going to talk about all the risk, and later on, I'm going to be explaining what are we going to do about some of this risk. Then we have earnings risk. I mean, in the downturn that the economy experienced after the COVID, you had a lot of people losing their jobs. That would be earnings risk, because part of what you have usually as an individual for your personal finance is you bank on the revenue that you are expecting. You bank on what can still come to you in the future. But if something happens and that is taken away from you, that creates a lot of problem. We have the market risk as well. Market risk is the risk that market prices will move against your portfolio. When we talk about market risk, we're talking about interest rates. There are 4 different things involved there. We're talking about movements in interest rates. We're also talking about movements in commodity prices. We're talking about movements in foreign exchange. We're talking about movements in equity prices. All of these come under market risk. So whenever anything happens in the market that affects any of these and then affects our portfolio, then that individual has experienced market risk. Then we also have what we call reinvestment risk. For instance, if I've invested my money, let me even say I put my money in the simplest of investments. Let me say I just put it in fixed deposits that is maturing or that matured, let's say this month. And let's say by the time interest rates, by the time I was going back to put my money back, please let me know if you can still hear me, because it's telling me that my internet is not stable.
Yes, we can hear you.
Is now giving me a rate that is lower than what I had before. All right, thank you very much. Then it means that I have experienced reinvestment risk. And this doesn't just happen with fixed deposits investments. It can also happen with your bonds. If I invested in bonds and I'm getting my coupon every half a year, it's expected that I should be able to get an opportunity to invest that coupon at a rate that will be close to what I am actually getting on my bond. But if the rates in the market is different from what it was at the point in time I invested in my bonds, then I may also be experiencing reinvestment risk. So these are some of the examples, it's not exhaustive, that individuals experience even in their portfolio. So we're going to be now looking at what are some of the things that we can do. In risk management, we have different risk management techniques. Now, these are our generic risk management techniques. I'm going to take some case studies, time permitting, very shortly, that I will now give you some of, tie some of the risks that we've talked about and how you can actually use some of these methods that I'm explaining here to manage them. But to give us a better pictorial view, I'm going to be using my white screen and looking at risk and the impact of the risk. So on this axis here, I have the impact of the risk that I might be experiencing. And on this other axis, I have what we call the probability of occurrence. The probability of occurrence. Now, in risk management, we divide this into we can divide it up to 15, 25 quadrants. Those who do proper risk management divide it into about up to 15 or 25 quadrants and be able to determine how to reduce the risk in the portfolio that they are managing. But for the purpose of our discussion today, I'm just going to divide it into 4 quadrants and explain them very quickly. In the first quadrant here, I have what we refer to as low probability, low impact events. These are events that do not happen often. And even when they do happen, the impact, the financial impact of such a thing happening is not high. So for instance, if you have a car and you're driving your car, you can have flat tire. So, but your flat tire, even if you have a flat tire or you have a problem with your tire, the probability of that happening, if you're not using second-hand tire, it doesn't happen often. But when it even happens, it's the impact, by the time you spend 1,000 or 2,000, you get your tire patched, you're fine. So because those kind of things does not happen often. So as I'm talking about your personal finance now, there are so many events in your personal finance that will fall into that space. So those are the events that we call low probability, low impact events. I'm going to talk about the 4 quadrants, then I'll come back and talk about what you should do under each of those and link it up to what I had in my slide previously. Then in my second quadrant, I have my high probability, but low impact. They can happen often, but when they happen, the impact of such an event, each of them is not a lot, right? So you can lock up your key in your wardrobe or in your car or something like that. I'm looking for events that can, but because I have time constraints, I'm not able to remember. But I'm sure you get what I'm trying to say. You can have events that happen often, but the impact of each of those, maybe like in the kitchen, burning food, you're trying to cook, you forget what you're cooking on fire, and therefore you're wasting your gas. And what were you doing? Maybe you were watching Netflix or something like that. This can happen often, but as long as it doesn't start a big fire, the impact of each of those events happening is actually small. Maybe you lose your pot of food and you have to start cooking all over again. Then I move to the third quadrant. These do not happen often. but the impact of each of them when they happen is high. So you have high impact. So I've heard of people who parked their car and they went maybe for a program or something, and by the time they came out, their car is gone. So that is not something that happens often, but the impact of that can be very huge when it happens. So what should we do in such when something like that happens? For instance, fire incidents don't happen often, but when they happen and they get the opportunity to spread, the impact can be very high. Then I come to the last quadrant where I have my high probability, high impact events. These are things that can happen often, and when they happen, their impact is also very high. So what should we do? So for instance, investments, there is that probability that investments can go bad. And especially especially when you do the high risk investments, and they can happen often. So what should we do in this kind of quadrant? So we start from the first quadrant, your low probability, low impact events. These are events that will say that as an individual, you should accept this risk. That means you don't need to be treating those kind of risks. You don't need to be moving earth to be able to manage your tire going down or the fluorescent in your sitting room going off, because the cost or the impact of it is something that is acceptable to you. So as an individual, you need to be able to identify those risks that because the impact is not high, you can accept it. So it's your comfort zone and you can do those activities, whether as it relates to your investments or something that you know that under any circumstance you are able to accept. Then we come to the ones that we refer to as your high probability, low impact. High probability, low impact, they can happen often, but when they happen, the impact of each of them is not high. And we say that in such situation, you should try to put in controls that will prevent such a thing from happening. So around your life, for example, steal your car. If you don't service your car regularly, you could have, issues with that car. It may initially not be significant, but if you allow it to continue like that, it can become very significant. Therefore, it's important for you to then begin to put controls in place, like putting reminders on your phone to ensure that you are servicing your car at the right time, to ensure that it doesn't go out of hand and all of those kind of things. Those are controls that you can put in place. Then you have your low probability, high impact events like losing a car and all of those things. And that's why we say you should transfer that risk or share the risk. Transfer or share the risk. And the most effective way of transferring or sharing risk is actually insurance. And I'm sure you must have seen it on one of the slides I had before. I would encourage us to take insurance. A few years ago, I put my laptop somewhere, and for me, my laptop is my most important tool, because as a consultant, that's all my life is in the laptop. And I left the office, went out. Somehow, an external person entered the office and stole that laptop. Now, if my laptop was insured, I wouldn't have been worried because I would know that I have a backup to go to immediately. But in that case, I didn't have insurance, and it really, because it was an expensive laptop, I really felt it at that particular time. Thank God I had someone who could borrow me a laptop before, who could lend me a laptop before I could get the opportunity to actually buy another laptop. So anything that is of value, because some of us, especially in Africa, we tend to say, insurance is just to steal my money. But the day you need insurance, that's when you wish you actually had it. So I would encourage us, around those of us that have homes, let's get home insurance, let's get our car insurance, let's do some of those things so that we don't have those. One of the things that people actually mention when we're talking about what has affected your finances the most is unexpected expenditure. So if you don't want to have some of those unexpected expenditure, let's make sure that we use insurance very well to reduce our risk, even as it comes to our health. I would always like to drop this in. There are two forms of capital that every individual in this world has. We have what we call your financial capital, and we have your human capital. Your human capital is you. I saw a video online before I joined, before this call. I just saw it in one of the groups I was on. And Warren Buffett was talking to a set of young people. And he said that if he gives them the opportunity to, I don't know whether, is anybody from the training trying to call me? Because somebody is calling my phone. I just want to be sure that I'm being heard. So he was going back to what I was saying. He said that if he gives them an opportunity to buy one car, and he tells them that what car would they buy, and that is a car they will have for life, what would be their choice of car? And the young people were looking at him, and he said, the next thing they will say to him is that that's not the only car that I'm ever going to have. I will get the opportunity to buy another car. He said, but you have a car that you're not going to get the opportunity to change. And that car is your body. So you must treat your body well. So our human capital is very important. I want to encourage you, if you want to manage your your personal finances very well, do everything you can to actually improve yourself. Do everything you can to improve yourself, improve your skills. That is part of being able to manage your personal finance, because that's what's going to increase your financial capital down the line. So if you're not managing your human capital, developing your human capital very well, it can go a long way to determine your ability to manage your personal finance in the future. Then we come to the high probability, high impact. These are events that when they happen, they can really cause a lot of havoc in our lives. And what we say that you should do there is avoid or mitigate. If you ask me, Funmi, give me another word for mitigate, is hedge. I would say hedge your risk. Try and reduce the risk around your business, yourself, those things, because you know that they are possible, and that when they happen, the risk is going to be high, and the impact is going to be high on you. So you have to make sure that you mitigate. So the rule of thumb, I'm saying that I may run out of time, but the rule of thumb is, no matter how beautiful an investment is, don't put all your eggs in one basket. That's the first rule of thumb. Diversify, diversify, diversify. So that no matter what's happening, you're not starting from ground zero. You're starting from, a more comfortable point of view. I was talking to someone a few weeks ago. He invests in the US market. I invest in the US market as well. And he told me, Funmi, I've lost over 50% of my investment. And I said, I have lost money, but I've not even lost up to 10% of my investment. And he said, Funmi, how did you do it? I said, it's all about, quite a number of factors, understanding the markets you're dealing with, understanding the instruments that you're investing in, making sure that you diversify very well, understanding the fundamentals of those investments that you're doing, so that you're not over putting your eggs in one particular basket, and at the end of the day, able to reduce the risk in your portfolio as well. I'm going to, when I start talking about some of these things, I'll give us some of those tips that I've been able to use. So what I have here is what I have used the graph to explain. So now let's look at, I won't spend so much time on what is happening on the global market, because I want to have enough time to talk about what we can really do. I don't think I need to educate any of us about what is going on in the world right now. The Russian-Ukraine war is affecting the whole world in terms of crude oil prices. Even the price of fuel at the station is high. Nigeria is one of the lowest, and it's because we have this subsidy still going on in the market, which we all agree is not sustainable. If you a while back, we had India, Indonesia banning the exportation of some of the products that they feel will affect them if they actually go ahead to keep on exporting them. And we are seeing empty shelves all over the world, because of some of the things that are going on right now. Inflation is not a Nigerian thing, it's a global thing. Yes, Nigeria may be affected more than some of the other countries that we have, but we've seen commodity prices rising. We've seen slowed growth, global growth. We've seen increased inflation in developed economies, not just even Nigeria, emerging economies like Nigeria. So it's a it's a big thing. Global inflation is expected to be about 6.7% by the end of 2022, compared to the historical average of 2.9. That tells you that it's a global thing. Nigerian situation is not better. It's worse because our growth, even though it's higher than what it was post-COVID, it's still not as strong as we expect it to be. And unfortunately, the populace does not even feel this GDP growth that we keep talking about because of factors, that we can explain, but it's just a reality. Exchange rate, even though it's around about 4.15 thereabouts, in the parallel market, it's peaked at about 6.12 early June. It's coming down now. I believe it's at about 600 right now, but I don't see it going below 580, even if it goes down. That means a lot for those of us that have foreign denominated expenditure like me, where your children are studying abroad. So what are some of the things that we need to do in such situations? Interest rates is rising, and it's not just rising in Nigeria, it's rising globally. Now, why is that very terrible? That's terrible because investors, foreign institutional investors that would normally be looking to emerging markets for higher rate of return are now finding that they can get higher return in developed markets like the US, the UK. So they don't want to bring, it will have effect on what we call our foreign direct investments. Why? Because they don't have to come and take on higher risk to get higher return anymore. So it means that it would also have a ripple effect on our economy. Unemployment rate is extremely high. The national one is 33.3, but I deal with a lot of, multilateral bodies, and they are interested in youth unemployment. Youth unemployment in Nigeria is higher than 50%. Is higher than 50%, is terrible, which means, and we say that over 65% of Nigerians are below the age of 35. So if more than 50% of that group is not getting employed, you see what is the effect that it is having even on our economy as a whole. The whole world is having issues, and therefore this has led to volatility, higher level of volatility in the equities market. I would say that the volatility in the developed market, because they are what we refer to as efficient markets, are even higher than what we're having in the Nigerian market. The Nigerian market has done actually better this year than quite a lot of the all the other markets. It depends on whether you were in that market. If you were already in the Nigerian market before it experienced some volatility in May and June, you would have been able to experience some level of growth in your portfolio. And those who are in that market would be able to tell you that. There were some stocks that I bought at maybe 7 naira last year, and they went as high as 17 naira, 18 naira this year. And the only regrets you have as an investor is, I wish I put more money into those stocks, but because I was diversifying, I probably didn't put more than that in that market. But bottom line is that markets are very volatile right now, whether you're looking at the equities market, the bonds market internationally, because prices are rising. We say that there is an inverse relationship between bond prices and inflation. And interest rates. So when interest rates is rising, bond prices will come down. Now, it even makes matters worse because under normal circumstances, I would say invest your money in bonds because you'll be buying low and be able to sell high. But unfortunately, the Nigerian bonds market from the COVID season up till now has been a little bit, there's been a lot of lull in that market. It's not been so active. There's not been so much trading. So which means that if you buy the bond, yes, the bond prices might have come down relatively now because inflation is up, interest rate is up. But then if you are not willing to hold those investments to maturity, you're going to have an issue because you may be coming to the market to sell it when interest rates will be down, and therefore you may not be able to get a good value for it. So I would say that before you invest in bonds, because bond prices should be down now. But again, because the market is not very liquid, you're not going to see that impact on bond prices falling as much as it should. Why? Most of the people holding bonds right now are institutional investors like pension funds, insurance, and the rest of them. Most of them tend to hold to maturity. So because they are not selling, you may not actually be able to take advantage of that. So you may want to look at it, but be careful before you go in. Cryptocurrency. I know that people may have questions for me on cryptocurrency, and that is why I have put it here. Of course, we have seen the value of Bitcoin and other cryptos come way below where they were before. As you can see, we got above 60,000 and it has gone down below. This is the market reality. Now, what has happened? Before, the cryptocurrency market was negatively correlated with the global market, which means that most times when the global markets were going down, the Bitcoin prices or the cryptocurrency prices generally were going up. So they were a good hedging instrument because you could be sure that when the market is going down, that is when your Bitcoin will be going up. But now it has become highly positively correlated with the market, which means that it is the prices are going to be going down at the same time the market is going down. This did not start in May 2022. It actually started, if you check here, around November, somewhere around November. That was last year. That was when I noticed that they had become positively correlated. So you need to be careful if you are buying Bitcoin because you heard some people were able to get advantage of 60,000. Be careful because it's no longer, as of now, a very good hedging instrument. Why? Because it is moving in line with the market. So before you become heavily invested in this, check the trend. Check the numbers, go and do your research so that you will not be making your portfolio worse. Because what we've seen now is people's portfolio falling significantly when they had thought that Bitcoin was going to help them to actually maintain their portfolios. Now, if you are playing on the international market, because I may run out of time, I just want to put it in there. There are still cryptos that are called volatility cryptos or indexes that you can use to hedge your portfolio. So you can do some of those, but it is not Bitcoin and some of these very common cryptos. Now, the question everybody will have for me again, let me quickly answer it. Do you think Bitcoin again is going to come up on the long run? But it's not going to be we are not going to see a rally to 40,000 in the 3 to 6 months. No, depending on what happens, you may see it when you're going towards 12 months, rally towards maybe around 35, 40. But those 60s and whatever may not happen for some time. So it depends on what is your position in that portfolio right now. That's what should determine what you're doing. Because of time, I'm going to just ignore my poll because my time is almost up, and then begin to talk about hedging the risk in your portfolio. How do we hedge the risk in your portfolio? I said something earlier on. I said there is no one size fits all. So that's the first thing I want you to go away with. There is no one size fits all. That means stop following people. Oh, this person has invested in this, let me also go in as well. And I think I have that point here. Majority may not necessarily be right. So be careful before you follow everybody. So the first thing you need to understand is understand your stage of life. Where are you? What are you doing? What are the factors that are important to you as of now? What are the things that you need to get handle of right now? How much risk do you have? And capacity do you have to take risk? There is a difference between what we refer to as willingness. Most of us are willing to take risk. If you ask me right now, Funmi, what kind of car would you like to drive? I would like to drive a Range, but I don't have the capacity to drive a Range. Not because I can't buy a Range, but if I buy a Range, it means that quite a number of other things are going to be suffering. So I have to, manage my own personal finance based on the factors that I have to handle, my requirements for funding, and what I need to do. I mean, I have a child in the university abroad, for example. I mean, the kind of funding that you require for that, I can't be comparing myself to someone maybe that has children, maybe in primary one, right now. we are different stages of life. So that would affect the kind of things that we do. And that would affect the kind of risk that we're exposed to. The kind of risks that we're exposed to would then determine the kind of hedging methods that we need to put in place at that point, at this point in time. Understand your horizon. A lot of us invest in in instruments as if we are day traders. Day traders are those who are ready to trade, practically immediately. But you forget the fact that some of those investments, you need a longer term horizon with it. So for example, if you're going into equities, yes, you could make some quick money, especially in the Nigerian market, because the Nigerian market is not an efficient market, a perfectly efficient market. So because it's not a perfectly efficient market, some of the things that you want to see, you may not see them manifest in that market immediately. Therefore, you can't just invest money take a loan that you need to pay in 6 months and go and put it in equities because you think that you're going to double it in 6 months. Ask yourself at the time you're going in, if I don't get the short-term turnaround that I'm expecting, am I able to stay in that investment? If no, then your best hedging method is what? Avoid. Don't go in, because if you go in, you might have issues. You might not be able to get out, within that short period of time. I've said, and I will keep on repeating, diversification is key. Do your research. Do not become risk. What do I mean by this? I need to really before we round up. Don't become risk seeking means sometimes, somebody investing. If I'm to ask here now, there are people who invested in Bitcoin when it was $40,000. It rose to $50,000. They didn't sell. They said it will go higher. It got to $60,000. They didn't sell. They said it will go higher. It got to about 62, 65. They said it will still go higher. They didn't sell. You mustn't be greedy with investment. That's a hedging, one of the tips you must go away with. Number two, it started coming down. It went down to 60. They said, no, it will go back up. It went down to 55. They said it will go back up. 50, they didn't sell. They are still in the money, as in they could still have made money. They didn't sell. Came to 40, they didn't sell. That's what we call risk-seeking attitude in asset management. That is portfolio management. That is risk-seeking. So you don't sell. You must have, and I think one of the points that I said I was going to put here and I eventually forgot was stop loss. You must learn to have that stop limit. When do I sell? When you're building a portfolio, you can't build a portfolio on a speculative style all the time to say you just want to be looking at your portfolio rise without having a time when you take your profits. There must be a time to take your profits. If not, you become risk-seeking, and it can really mess people up. Now, there are people who bought those, Bitcoins, and they bought significant amounts when it was going for around 40. They didn't sell, and now it is at 20. They are stuck. What do? Do you now sell, or do you wait until it goes up? So what is your view of the future? Do you expect it to go back to that 40,000 range in 1 week, or in 2 months, or in 5 months? What is the money you have put there? Is it money that you require for other aspects of your life, maybe paying school fees and a whole lot of other factors like that, so that you are under pressure? You are putting yourself under undue pressures. These are the thoughts that these are the general thoughts. I have case studies, but maybe I will hold my case study until we see some of the questions that we have. Unless there are no more questions, then I will take my case studies. What are the expectations about the future, so that this can also help you to develop your hedging strategy? Bonds, rising interest rate, like I said, means lower bonds may be interesting, but watch out for liquidity, so that by the time you want to sell, especially if you're buying Nigerian bonds, you would actually be able to sell. We need to be very careful about that. Cryptos is now positively correlated, like I said. It's expected to still rise, but mark my words, it's for a patient investor. So if you haven't bought, you may want to buy now, and hopefully it won't go up. Somebody will say, for me, what if it comes down? It can still come down. So I have to say that it can still come down, because nobody knows the bottom of the market, and some of those markets are responding to online real-time issues. So if something happens, maybe the whole of NATO decides to go to war with Russia, then those things can still come down. So you need to be careful the kind of monies that you're putting on those very volatile markets. Real estate, be careful. The Nigerian market is better than the larger economies in terms of a bubble burst right now. If you want to actually invest in real estate internationally, particularly the what's it called, US market, I might want to advise you, maybe you want to hold on to that money for some time, earn lower return for now, because those markets are very close to the top. And right now, because interest rate is rising, is going to cause the borrowers not to be able to borrow as much, which will eventually lead to lower demand. And once there's lower demand, there won't be, the prices in those markets will not rise as they are rising right now. Equities markets are they will continue to be highly volatile. They are not yet at the bottom. So expect more repricing, especially in the international market. The Nigerian market, you can cherry pick. For the Nigerian market, there are stocks you can buy in the Nigerian market now that are rightly priced. So if you talk to some of your asset managers, they will advise you. But some of those prices may be high already. So be careful where you're buying. If a stock is about to declare dividend in Nigeria, please don't buy, because people are buying to take advantage of the dividend. So if you buy at this point in time, you may be buying at a very high price. So it's all about timing so that you are hedging that market risk. So timing is what you need to watch out for to avoid market risk, because market risk is something that is beyond you. You can't control the market. So it is about the position that you take that will determine what happens to your own portfolio. Private equity, private debt. A lot of people have lost money here on those crowdfunding platforms. It's not that they are wrong. It's not that they are not, because they offer relatively higher return. It's not that you can't do them, but you need to ask questions. Ask questions. Don't just give money to people that are just going to be investing and you don't know where they are investing. Know the fundamentals. Know the companies that they are investing in. Know the fundamentals of the companies they are investing in. Do your own research. Follow up. Don't just leave your money there and not check what is happening in the market. You can make money there, but be careful. That means you need to do deep analysis. Mutual funds are also good investment to have, but again, it is all about timing. Because if you are entering a fund and the net asset value at that particular point in time is high, I mean, there was the joke. I want to make a joke, about my husband. There was a particular mutual fund he invested in 2008. And then he called them this year to say he wanted to liquidate. And they were giving him a value that was lower than what he invested, or just about the same price as what he invested in 2008. And it was like, what? How can you people be telling me that that's the value of my money? I said, but that it's a mutual fund. So it's all about timing. So one of the things I would say is that the market risk that we are all scared of, check the instruments that you want to invest in very well and make sure that they are not at their highest levels, so that you will not be investing at the wrong time and therefore bailing other people that are trying to offload their own positions. I think I will just stop here for now. I have more to say, but they asked me, they wanted to give me 1 hour. I was the one that said they should give me 45 minutes because I thought I wanted to have more time for questions. So I still want to have more time for questions. So let me see what kind of questions we have before I take the case studies that we have, because I can answer those same questions. I can use your questions to discuss the case studies that I have already created. Thank you very much. Over to you, Kike.
Yeah. Thank you very much, Funmi. I'm taking over. It's been very, very, very interesting. I think a number of things stood out for me, particularly the fact that beyond even hedging your personal finance, it's important to hedge yourself because you're your most important personal finance. So, I mean, there are a number of things that they're saying about the job of the future right now. So you want to upskill yourself so you're not obsolete. That's the first thing. And I mean, a number of things around diversification and all of that. So yeah, there are a lot of questions already in the room. Most important one that people are asking for me is if you would like to share your presentation and the video. I don't know if you're happy to do that. The institute can share it with everyone that registered. Is that okay?
Please go ahead. I'm going to forward it to the, I think it's already with Rita. So please go ahead. That will make me very glad. Yes. It's free.
All right.
Yes.
Okay. Now, into the questions. Tayo Karunwi is asking, where does one invest to hedge inflation? What kind of securities can I invest in that can help me curb inflation increase?
All right. Thank you very much. Okay, so when we talk about inflation, to hedge inflation, real estate is very good if you have the funds to do it. So it depends on, like I said, it depends on where you are at a point in time. If you have money today and you buy real estate, I mean, there are properties that maybe you bought about 5 years ago, 10 years ago. You can, I'm sure those of us that have invested in real estate 5 years ago, 10 years ago will agree that it has hedged against inflation for us. So if you are not yet concentrated in real estate is a good one. You can also still invest in equities, right? But for your equities, you need to be choosy. You need to be choosy because it depends on the fundamentals. So the share, and it depends on the time. If the market is already overbought, that means that the prices are already high. If there are some stocks that from 2008 till now, they have not recovered. So the equity may not necessarily hedge inflation for you, but it may if you're entering at a good price. So if you understand how to value the market and you buy a stock that is currently undervalued, you are likely to be hedged for inflation over time. For instance, some of the stocks that I invested in last year compared to the kind of returns that I got from those shares, Nigerian shares, from last year to this year has actually hedged, is way beyond what inflation did. So stocks can do that for you if you're able to actually go into the right stocks. Those are two major investments coming to my mind now. I mean, I can't think of any other one that can, outrightly always. Gold is also always good. But I'm trying to be realistic about some of the things that most of us in Nigeria get access to. But yes, for women, for instance, I mean, we can testify to that. If you buy gold and you hold on to it for 5 years, you want to sell it, it always hedges you against inflation over that period of time. So not all commodities can hedge you because commodities tend to be positively correlated with world growth and whatever is being expected on the world economy, especially in Nigeria, we don't process. If you process, you get more value, but we really don't have processing capacity. So some of the commodities might have helped as well. But because, for instance, if I take a commodity like cashew, for instance, I have a lot of SMEs operating in the processing space in cashew. Now, because the Naira has depreciated against the dollar, they can get a lot of value and they would have been hedged against inflation that is going on in Nigeria. So it depends on which part of the value chain you're going in. You may not be hedged against primary production. That means the commodities that the farmers are doing. The farmers don't get the value. The traders and the processors get the value. So the farmers, the traders and the processors can be hedged against inflation in commodities markets, but the primary production people, they don't tend to get most of that value from what we have seen in real life. So commodities could help, agri-commodities could help, depending on which value chain, part of the value chain you are playing and the commodity that you're playing in. So for instance, if you have money today, you may want to do, what's it called? Maize, soya beans. Those are going to skyrocket in the next few months. because of world economy, the Russian problem, and the requirements for it by a lot of industry. So it depends on which commodity. You need to have a macro view of what is expected in some of those industries, then you can take position. So in summary, you can do real estate, you can do commodities, you can do commodities, you can do equities, depending on, but making sure that you give room or value for the cognition for the fundamentals of those stocks. Yes, which other one did I mention? Gold. Yes, thank you. Back to you, Kike.
Modupe.
Sorry, Modupe.
Hi.
Sorry, I thought it was Kike that was.
Yeah,
Modupe, sorry.
no problem. No problem.
Yes. Yeah.
Thank you for that. I think it's important to know, just like Funmi mentioned, it's agriculture, please. I mean, I know a number of people have been investing in crowdfunding agricultural products. It's not the same thing. So it's just always important to know, like she said, the part of the value chain that you are. So don't say that the CFA Institute recommended that I should go and invest in crowdfunding for agriculture and then your money got missing, please. Okay, Blessing Eroto is asking, she's asking for the examples of the stocks. You mentioned that you had bought the stock last year at 7 Naira and now it's at 17 or something. So she's trying to get the names of those kind of stocks as well as the volatile cryptocurrencies that you also mentioned. I mean, just to put that disclaimer again, we're not recommending anything as it were. It's just from personal experiences. And just like Funmi mentioned, please do your research. So
okay,
yes,
thank you very much, Modupe. And I'm even going to tell them that I took my own profits. I didn't want to become risk-seeking. So it may not necessarily, because I'm saying it, you're asking me and yes, I can tell you. So I bought, I can share just 2 of the ones that I bought. Or I don't want to, oversell it before everybody goes to buy. Please, it's too late to buy now. If you didn't buy last year, it's too late. The examples or the ones I was able to cash in on was PZ last year and Cadbury. They were at about 5 Naira, between 5 Naira to 7 Naira. And I bought at that particular point in time. And they both went up to about 15, 17 Naira. And I sold, because I didn't want to become risk-seeking. Why? Because I knew that those shares would still come down again. Most important reason why they were going up was because people were trying to get into their dividend space and a lot of other factors like that. They may never come back to the 5 Naira or 7 Naira, but I'm fine because I've already taking my gain. So it's about not being greedy. So that's an example of what I did, right, last year. So please, CFA is not, if you need advice, I am not even a portfolio manager, active portfolio manager like that. I do portfolio management for myself and a few of my family members and friends, but I don't do it on a commercial basis or like that. So I'm not even the person that you're going to come to. I'm just giving an example for you to know what we're talking about. So that's an example of what I did last year. So you need to now go and do your own research and find out those stocks that are currently underpriced in the market. So it is not what is going to work for you this year, because those things have already increased, and you can check what is it called, the prices that are there. Now, as to the volatility index for the US, that one is something that I will give to you. It is a volatility index, or it's actually under cryptos in my portfolio. So you need to understand that it is high risk. And before I started playing it, I took time to understand it very well. So don't say Funmi told you to invest in it. You want to know the name, I'm giving you the name. The research, understanding it is left to you, please. So if you want to have it, it is called UVXY. That's the name. UVXY, you can check it on the US Stock Exchange, and you can see whether you can play it. Usually when the market, let me tell you how it works. When the market is going down, it goes up. When the market is going up, it goes down. So it is not something you have in your portfolio on a permanent basis. When I go and check the market and I see that the market is on a downward trend today, and I think that trend is going to sustain for at least 2-3 days, then I buy UVXY for the purpose of gaining that on that index. I buy, and then the 2-3 days I sell it. So it is a short-term investment hedging instrument. So, but I don't want to be, selfish by not sharing it. That it's going to always work like that because it's a volatility index So it's going to always work like that. So if you join me in playing it, it doesn't mean it's going to, it doesn't mean that it won't work that way again. So you're welcome to check it out, but please do your own research. If the market is not going down for at least 2-3 days in a row, if you buy this, you will lose money. So please don't get in and don't stay in there. It's just something you go in and you go out. Thank you. Back to you, Modupe.
All right. So Akishola Daisy is asking, why is mortgage interest rate higher than commercial interest rate in Nigeria? I'm assuming this to be the inverse. So that's what he's asking.
Okay, so in Nigeria, interest rates, mortgage interest rates are quite high. They are quite high. They will hover depending on your risk, because the banks will look at your rates, the risk involved in doing your business, in doing business with you, the organization you work for, and a whole lot of other factors like that. To the best of my knowledge, interest rates, and please, bankers here could disagree with me if I'm outdated, your mortgage rates can range between 16% to sometimes up to 22% right now. And that is quite high. Why is it higher? Is because we don't have long-term funds, in the financial sector that can help us to do mortgages the way it's done internationally. Some of the instruments that could have helped that market to grow have not really been introduced in a very well in Nigeria in a way that would bring down those rates. So ordinarily, you should be talking about single-digit rates. You're not going to get that. So if anybody is going into mortgages, you want to be very careful. 2 things that you can do to hedge your risk there. Number one, if somebody is giving you, let me just use for an example, 20% as your mortgage rate, it means that by the time you've taken 30 million for 5 years, you would have paid almost 60 million. Go and check it, because that 20% is translating to 5%. And 5 years, I mean. So you would have almost paid double. So how can you reduce this? Understand the power of prepayments. So even though they tell you to be paying 200,000 every month, if you have the capacity to pay 400,000, pay 400,000. What that does for you is that it reduces the effective interest rates on that transaction. Why? Because the interest is calculated based on the principal outstanding. So if you're supposed to pay 200, the 200 will be shared amongst interest for that period, and the rest will be principal repayments. If you pay an additional 200 for the same period, that additional 200, everything goes to principal repayments, which then brings down the interest that will be calculated for the next period, and so on like that. So interest rates on mortgages is high in Nigeria simply because we don't have long-term funds available in the economy. The government has been working on this for some time, but for reasons that we can all talk about, it's not been working the way it's actually supposed to work. Thank you.
All right, thank you, Funmi. We have another question from Rita MOFA. She's asking, can we completely hedge out our losses or decline in our portfolio? What do you think?
Because when thank you very much, Rita, for that question. It's not possible because we have what we call diversifiable risk and non-diversifiable risk. As long as you're in a market, like I gave an example earlier on, two people are playing in the same market. Somebody has lost over 50% of the value. The other person has lost by like 10% of value. So it's not possible to say, so the two of them have lost, but it's just that diversification and right analysis can help you to minimize. That's why we use the word, mitigate. You are just trying to minimize. It's not that it is going to be possible. As long as you're in a market, you are already exposed to what we call the market risk or non-diversifiable risk of that market. So it's not everything that you can diversify. It's not everything that you can hedge. So there will still be some, but it's just that taking some steps. For instance, if you have dollar responsibilities, trying to begin to earn in dollars, trying to begin to get some of your income maybe in dollars, or converting some of your portfolio to dollars so that depreciation of the naira does not affect you. Those are things that you can do to reduce the impact of what is happening in the marketplace.
All right, thank you for me. Another question from Daniel. Daniel is asking, how does one know that prices have peaked so not to invest? So kind of like, when is the right time? How do you tell the right time to enter into an investment?
Honestly, Daniel, if we all knew that, what is it called? Answer. I think we'll all be billionaires right now. So we tend to know it's not possible to know the bottom of the market, as it is not also possible to know the peak of the market. It's understanding the fact that if you notice today, when I was talking, I brought in macroeconomic factors, and then I'm able to interpret the market in the light of those macros. So understanding where you are, or whether it is time to buy or to sell, is number one, understanding what is going on in the, what we call the capital markets expectation, what is going on in the macroeconomic environment. How does that impact the different instruments? So equities respond to macro factors in a different way from bonds. Now interpreting that, like I said, interest rates going up, it affects bonds more than it will affect equities. So what should be my position based on my interpretation of the market? So if you want to be a good investor, you need to begin to understand, listen to a lot of news. What is going on? So what is the impact that people are saying? There are people that have podcasts on YouTube, and they talk about some of these things and the impact of some of these factors and what they expect to see. So you need to begin to read more of those documents. That's where you will know whether the market is high. If you've been following a few people on YouTube, they've been talking about the bubble burst in real estate, especially in developed markets, because those prices are high for most of those markets right now, some more than others. So that helps you to take a good decision. And then maybe talking once in a while to a few people that maybe your friends that have a little bit of financial knowledge can also help you to figure it out. But it's a little bit difficult if you don't, it comes from the knowledge that you've built over time about how to interpret what's going on within a particular economy, industry, and company. That's what helps you to know whether it's the right time to buy or not. Thank you. Over to you, Modupe.
All right, thank you for me. Arafat is asking, how do we find cross-border investment opportunities outside the present bamboo and rice that we have for stocks, and then Nigerian mutual funds for Eurobonds? So he's just trying to get other outlets to which he can invest internationally.
Unfortunately, Arafat, I think we, as Nigerians, some of us may be stuck with those instruments or those platforms that you have talked about. Because for example, the only reason I am able to invest directly in this US market is because I have a social security number. So based on that, I mean, it's easier for me. But if you don't have some of those things, it's a little bit difficult to get into those spaces. And therefore, you have to stick to the platforms. And I understand your apprehension. Sometimes I am not sure if I didn't have an access to do that on my own, whether I will be 100% going for some of those platforms, because maybe I'm the wrong person to make that comment, because I don't know how those platforms operate, right? So you need to check the safety of your money before you begin to put them on those platforms. And if you're sure that, yes, you're going to be able to get your money 100%, then fine. And it's because you're not investing directly, it's like they are investing practically on your behalf, from what I understand. As to other platforms, honestly, unless you have been able to integrate with some of those markets, it's difficult to begin to get investment opportunities. Now, if you are a Nigerian and you want to invest in real estate in some of those developed markets, you can. You don't have to have social security number. It just means that you need to have your liquidity ready, and you should be able to get into some of those markets. So real estate is one additional group of investments that you can easily get into those markets without necessarily being part of that system. But when it comes to their organized markets, there are markets that have clearing houses, you probably would have to go with the platforms that you are currently using right now. Over to you, Modupe.
All right, thank you, Funmi. I think Sonia has an interesting question here. Sonia is asking if investment in fine art and wine can help hedge inflation.
Thank you very much, Sonia. It is actually a good one as well. But remember that those who benefit from those kind of investments must have a long time horizon. That means it's not the kind of investment that you're doing and you need your money in 1 year or 2 years. In fact, I always laugh at, the issue of fine art. You tend to get your money from it more when the artist has died. Or a few, there are a few that even though they are alive, their arts are doing very well. So yes, you can actually do those, but bear in mind that those take time. The wine, it has to become vintage wine, and the longer the life, the better the value. So I think that might actually help if you begin to do some of those things, but your investment horizon may need to be long. So in other words, I'm saying that the funds you put in those kind of areas would usually be those ones that you don't need those funds immediately. Thank you. Over to you, Modupe.
Okay, so we're only able to take 2 more questions. I mean, because there are a number of questions. But then Larry White is asking, is it advisable to have like 90% of your portfolio invested in real estate? I think the answer to that is, from all you said, is quite obvious. But yeah, over to you, Funmi.
Okay, so Modupe, as you would also agree, most of us, whether knowingly or unknowingly, the greater percentage of our portfolio, if you're taking the whole of your portfolio, is always represented in your real estate, especially where you have a house and then you're doing so many other things like that. So naturally, the real estate, once you have it, tends to represent a huge chunk of your portfolio. So now it depends on what type of real estate you have. Do you have investment? I had in fact, let me use a practical example. I had a client once that came to me to help her do her redo her portfolio. So we started from her investment portfolio statement. And what we realized was that she had a lot of in real estate. In fact, this example that was just given is what she had, but she was always broke. She was always broke because she had no liquidity. So she had land, she had properties in very good locations in Lagos, well over 300 million naira. And she said, Funmi, I'm always broke. And I said, you will be broke if your money is tied down in this. And, even when her tenants pay rent, because she's so used to investing in real estate, the first thing that comes to her mind is to put the new investment in real estate. And therefore she's cash trapped. So the first thing I had to tell her is that you need liquidity in your portfolio. When are you expecting your next rent? She said, the next rent, we are not putting into real estate. You have to put into, bonds. She's a retiree. So you have to put into bonds. You have to put into fixed income instruments so that you can, on a monthly basis, be getting something that will give you income. Then put in some shares that pay very good dividend so that when you receive your dividend, you can then on an annual basis be able to get that for managing yourself over the next 1 year. And that was what we were able to achieve in that portfolio. So if you put, I've forgotten his name, but if you put 90% of your portfolio in real estate, expect to be cash trapped unless you have ongoing, income from another source. Maybe you are employed and therefore you have enough liquidity to meet your requirement. But remember that real estate is also a cyclical industry. So if you lock up 90% of your investment there and the economy goes down significantly, value of real estate can also come down. So what would then happen is if you needed to unlock some of that value at that time, you won't be able to. You will have to wait until the economy recovers, which in some cases could take 2 years, could take longer than that, than what we've been experiencing in Nigeria in recent times. Thank you.
All right, and the last question would be just to get your thoughts on cryptocurrency. You had mentioned that it's important to understand the investment that you are putting your money into. And so, I mean, despite people trying, and I'm not sure that a number of people still understand what is backing cryptocurrency. So I would like to just get your thoughts on that.
Okay, cryptocurrencies are not, they are like digital currencies. You know, what is currency? If you start from where currency and the legal tender started from at the beginning of, so many centuries ago, it's two people agreeing that a particular thing has a value, and that's value, then so if I want a laptop and I believe that 1,000 cowries is as valuable as a laptop, then I give you 1,000 what's it called, cowries, and then you give me the laptop. Things like that was how legal currencies or legal tenders started. So it's still the same thing in a digital format that is behind the Bitcoin and all the cryptocurrencies of this world, where people have, just mined or created currencies that will never be paper, because the idea is that we are going towards a cashless environment, and therefore we will not need all these notes that we are carrying around. If we don't need the notes, then we need to create a currency that is purely based on digital currency. And that was how the cryptos started. And therefore, the value that you pay for it, I mean, I remember one of the stories I read about the Bitcoin, which was one of the first cryptocurrency to really gain attention. The person paid maybe 10,000 Bitcoins for 2 pizzas. So he was on one of these platforms and said, I want to buy pizza. Who will collect 10,000 Bitcoin and send 2 boxes of pizza to my house? Somebody took the gamble. At that time, 2 pizzas were less than $40, even if you're buying the biggest size. And they sent it to his house, and he forwarded 10,000 Bitcoins to the person, and the person became a billionaire out of those 10,000 currencies. So it's based on demand and supply. So the more people accept a currency, the more value such a currency will have. It's just that if for example, people began to accept Naira, now you will find out that our currency would also do a lot better than what's in other jurisdictions apart from Nigeria. Like, then the Nigerian currency will have more value than what it has now. Same thing with the cryptocurrency. So that's the idea behind it. But people should understand that there's a difference between trading Bitcoin directly and trading. There are so many other platforms that have, people that have taken their own owning of what is it called, Bitcoin, for example, to create other mining opportunities. That means you're not trading directly, you're trading under somebody. So, I mean, it has now gone beyond the normal just trading on a particular platform to other factors or other people trading their own ownership as well, and breaking their own ownership into smaller units. So what people then did was, because one unit went as high as $40,000, $60,000, then there was a need to now have those micro portions of it, so that people could buy smaller portions of it with smaller amounts of money. And that is when it became so popular. And then in fact, one of my staff was telling me that Nigerians that maybe importers in Nigeria now trade with Bitcoin because they don't want to carry money around. They can go to China and then exchange Bitcoin for some of the goods that they are buying. I mean, it's as long as it's acceptable, then it becomes more popular. Thank you.
No problem. Thank you very much, Funmi. Thanks all over to you.
I'm so sorry. I've been speaking. Okay, thank you very much, Miss Adepoju. Thank you, Dupe. This has been an interesting session. The few points I just want to emphasize is to talk about the reality that personal finance has to be a deliberate action, meaning she said something about set your goal and then understand it. These are activities that you have to be deliberate about. You have to be clear You have to take time out to sit down and think about it. And this is what I'm saying to myself. And another thing is that I don't know if you're able to absorb all what Mr. Adepoju has said, but the reality is that we all need to sit down with our wealth portfolio advisor. I'm no portfolio advisor, even though at some point most of us are in finance, but we need to understand that people have various expertise, and we need to start talking to the people that do this on the daily, and this is like their bread and butter. Don't take any of what Mr. Adepoju just said for granted, the commodity, the investment, the real estate. When you sit with an expert, part of what they will be discussing with you will be your goals and your time horizon, things that we can't cover here. And it will also help you see your spending habits, how you're moving forward, and where you should be going to. So I would want to encourage us to actually take this a step further, put some action into it, make that call. Don't procrastinate this action at all. And I also want to say thank you to our attendees. Like, our room was full, thank you so much. On behalf of the Gender Diversity Committee, we say thank you. We do not take this for granted. We are glad that we all could join this meeting, and we participated. We would continue to do more. And I just want to take this opportunity to talk a little bit about what we do at the Gender Diversity Committee. We're trying to encourage more female gender in the finance and investment profession. We also do women in management mentoring, where we female have mentors that can help us with our career decisions, and it's been an interesting program. We also profile scholarship for young women that are interested in writing the CFA based on some criteria. So we really want to encourage volunteers. When you're interested, if you're interested in joining us, please, you can always reach out to me, Fentola Adeshoyin, or Rita Momofe, or Modupe, that's been the coordinator. Thank you so much. Please, let's continue the conversation and the question on our forum. The link is right here on the chat box. We'll look forward to having more sessions with everyone. We will work hard to increase our room arrangement so that we can get more attendees in, because I got some people saying they couldn't join. But thank you so much. And thank you, Ms. Adepoju. This has been an awesome session. Thank you so much. Thank you, Dupe. Thank you, everyone. And have a wonderful week.
Thank you for having me. Thank you. Bye.
Bye.
Thank you, everyone.
We are professionals. We are impact driven. We are CFA Society Nigeria, a member society of the CFA Institute Global Network of Societies. Our mission is to promote the highest standard of practice in the Nigerian financial services industry and provide a vibrant community for our members. The CFA Charter signals the holders' commitment to professional excellence. As thought leaders, we collaborate with stakeholders to ensure adherence to ethical standards, better education for professionals, and to build market integrity. We are the leading voice for advocacy in the finance and investment industry in Nigeria. To partner with us or become our member, visit us at cfasocietynG.org for more details. CFA Society Nigeria, making finance a force for good.